Today, I want to talk about a company that people love and love to hate. This telecom giant has a long and storied history, plagued by both debt load and customer demand in recent years. Taking strides to reduce debt and focus on the new 5G network, I think this company stands in a great spot to dominate its industry. If you haven't figured it out yet, today we're talking about AT&T. Hey everybody, and welcome back to Dollars and Cents, helping you make sense of making dollars. AT&T's roots run all the way back to 1899, making it one of the oldest public companies in the US. At one point, it got so massive that the US government broke the company up in an act to prevent a monopoly. Since then, though, the company has massively grown, bigger than it ever was. However, the company is plagued with a hefty debt load in recent years, causing AT&T to take drastic measures. Much of these actions included selling off non-core assets like Rooster Teeth, DirecTV, and Crunchyroll. Plus, another deal with Discovery allowed AT&T to offload WarnerMedia for $43 billion. All these cuts led to the company slashing its dividend, causing its stock to sink to historic lows, passing that of even 2008. But is this sell-off warranted? Is AT&T still worth buying today? And can the organization continue growing against stiff competition? In order to answer these questions and more, we have to first look at AT&T's finances. First, let's look at revenue growth. In 2015, AT&T raked in a whopping $146.8 billion, making it one of the highest revenue companies in the United States. As of last year, it grew to $171.7 billion. Interestingly, unlike many other more tech-based companies, revenue actually fell compared to 2019. Second on the list is, and it's not pretty, shares outstanding. In 2015, the company had 5.6 billion shares outstanding, and then in 2020 they increased that amount to 7.16 billion. The company appears intent on diluting shareholders. Moving on from there is free cash flow growth. In 2015, the company pulled in $16.6 billion in free cash flow. Last year, it pulled in just under $27.5 billion in free cash flow. All of this is impressive growth from a company as massive as AT&T. Now, instead of looking at current assets versus current liabilities, we're going to look at the last 3 years of EBITDA compared to the company's net debt. Currently, AT&T's EBITDA average stands at $57.2 billion. Compare this to the company's net debt of $307.8 billion. Usually, you want to see this number under 4 times, since it signifies a company is able to pay off its debts in a reasonable amount of time. But unfortunately, that's not the case. AT&T's leverage amount stands at 5.3 times its 3-year EBITDA average. Definitely not ideal. Next, we'll get a rough price to pay using its free cash flow average. If we take the average of the last 5 years of free cash flow, $22.63 billion, and multiply it by a multiple of 20, we get an expected market cap of $452.6 billion. Currently, AT&T's market cap is just $165.3 billion. So, using this model, AT&T appears to be significantly undervalued. Let's take a look at AT&T's return on invested capital. Over the last 5 years, on average, AT&T put up a 5.2% ROIC, well below our goal of 9%, and last year's ROIC of 5.7% wasn't much better. This is below our goal of 10%. Now for the most important part, AT&T's dividend. Currently, AT&T owns a monster dividend yield of 9.11%. This comes with a 61.6% payout ratio and a 5-year annual growth rate of a measly 1.61%. Overall, based on these numbers, I think AT&T is a solid business. While it still owes a large amount of debt, I believe the company is taking great strides to reduce the load. The only other thing that is concerning is the relatively low return on invested capital. A rate of just over 5 means management isn't doing a great job at allocating capital. With all that said, let's see where this capital is going to determine whether you may or may not want to invest in AT&T. I think there's actually a solid case for AT&T moving forward. Over the past year, the company has done what I think is an excellent job at consolidating its business. Up to this point, AT&T focused on increasing revenue by any means necessary, possibly to sustain its dividend. Recently, though, the company announced that it would be cutting its dividend in half. Thus, AT&T won't have to worry about pleasing its longtime dividend growth investors. With CEO John Stankey at the helm, the company saw a lot of changes. The biggest of those was spinning off WarnerMedia in a merger with Discovery. The merger won't likely happen until the second quarter of 2022, though. All we really know about the deal is that AT&T gets $43 billion in cash. Whether it's actual cash, transferring debt from AT&T's balance sheet, or debt securities, we don't really know. What's apparent is that AT&T is getting $43 billion in cash from this deal. I mentioned earlier that AT&T's biggest problem has been its debt. Getting rid of things, consolidating, and getting money through these deals should unlock AT&T's ability to grow again, and to allow it to be boring again. And I think that's what a telecom company should be. Boring. There's no need to chase the streaming hype train or broadcast the latest and greatest TV shows. At its core, AT&T is a boring telecom company, and there's nothing wrong with that. It has 66 million phone subscribers and nearly 6 million fiber subscribers. Both generate massive amounts of free cash flow. Plus, both of these areas are steadily growing. Not exciting for sure, but we like steady. On top of that, these recent divestitures allow AT&T to focus on one of the most important upcoming trends, 5G. If you're not sure what 5G is, then look at your phone. You may have 3G or 4G service. 5G is essentially the 5th generation in phone service technology for cell phones, the successor to 4G. The 5G market is expected to grow at 50% over the next few years, and most of the industry is still very fragmented. With its new financial flexibility, AT&T is poised to take advantage of this growing trend. As with anything though, there's always a few downsides to consider. My biggest fear is that AT&T won't escape from its locked pricing war with the competitors T-Mobile and Verizon, although it's in the best position to compete with them. This pricing war has compressed AT&T's margins, forcing it to offer more services at a lower price. Great for consumers, terrible for business. Plus, despite being the largest mobile carrier in the US, AT&T has struggled over the last few years to generate free cash flow from its mobile business. We can see that by looking at the holy grail of tech companies, average revenue per user, or ARPU. According to its most recent earnings, AT&T's postpaid ARPU for phone plans was down 0.6% compared to last year. That may seem small, but consider that AT&T's customer churn is now 0.92% from 2020's 0.85%. More customers are leaving AT&T, and on top of that, they're making less money from the customers they do have. It could be a post-pandemic comparisons thing, which could be very difficult, but the trend is still downward. Very worrying indeed. Another issue I see is that AT&T has sold all its high-value growth assets. This could lead to the company going nowhere for years. The potential of the 5G market can provide a much-needed push for the company, true, but I don't know that that will be enough. Again, the 5G market poses a lot of potential. It's a massive new tailwind, and many companies will certainly pop up to siphon some of the potentially massive gains. Already, we can see new mobile carriers cropping up to cram their way into the market, like Mint Mobile, Visible, and Cricket Wireless. Even Google is getting in on the action. All that creates is incredible new competition, and it will only get harder for AT&T to continue to compete in the only industry it now profits from. So that leaves us with the question, will I be buying AT&T? The answer? No. I think AT&T is a boring but solid company that probably won't be going anywhere anytime soon. That said, I don't see its growth plans taking off in any meaningful way either. Its dividends, while once hurting the company, just aren't attractive enough for me to consider it for that reason either, and its relatively slow growth overall, if it sees any, doesn't appeal to me either as a growth-centered investor. All that said, I don't think that AT&T really has much downside from this price, so if you do decide to invest, right now might be a good time to do so. As always, there's links in the description so that you can get a head start on research. Then you can make the decision whether or not AT&T is a good fit for you in your portfolio. And that's all I've got for you in this video about this telecom giant. Leave your thoughts in the comments section below or join my Discord where we can talk more. Until next time, I'll see all of you in the next episode of Dollars and Cents.